Is STRC eating the private equity market?
That's the multi-trillion-dollar question right now. And I mean, if we look closely at the data crossing our desks, it really suggests the appetizer course has already been cleared. The main course is currently being carved up.
Welcome to the Deep Dive. I'm Satosha.
And I'm Satoshi.
Welcome in, everyone. We are so glad you were joining us for this one. Today, we're bringing you into a massive, frankly, historic structural transformation that is unfolding right now in early 2026.
It's massive.
It really is. We have a towering stack of research on the table today, and our mission is to examine a fascinating and somewhat terrifying divergence happening in the $1.8 trillion credit market. On one side of the ledger, you have traditional private lending, the old guard, and they are showing some profound structural cracks.
Right.
But on the other side, you have this radical new digital asset-linked preferred security that is surging in a way that is just completely upending the traditional financial rulebook.
It's a remarkable divergence to witness, and it's crucial to understand that this isn't just some niche financial trend. This isn't a flash in the pan or, a temporary market anomaly. We are talking about a fundamental shift in how capital is protected, how yield is generated, and ultimately how money is deployed at the highest levels of global finance.
Yeah.
When you have institutions completely rethinking their allocation strategies from the ground up, a tectonic plate has shifted.
I am genuinely fascinated by this because we are watching something as traditional, as fundamentally unglamorous as a corporate bond being totally reinvented.
Yeah.
Before we get into the weeds, though, just a quick reminder for you listening. We are going on a collaborative journey today. We're going to uncover exactly why the smartest, most sophisticated money in the world is moving so incredibly fast right now.
And to really grasp the magnitude of this shift, we have to start by looking at the reckoning, the great credit pivot of 2025 and 2026. Because the sheer scale of the private debt market right now is staggering, but I mean, it didn't get there overnight.
Staggering is definitely the right word. To appreciate the vulnerability here, trace that trajectory for us.
So back in 2020, the private credit market was sitting at roughly $500 billion, which is a substantial amount of capital, but in the grand scheme of global finance, it was manageable. It functioned mostly as it was intended, right? Providing bespoke, flexible capital to middle market companies that might have been too small or too complex for a traditional bank syndication.
But then the environment changed.
Exactly. We saw an era of near zero interest rates combined with a massive pullback from traditional banks following increased regulatory scrutiny. Investors were starved for yield. They poured capital into private credit with reckless abandon. By early 2025, that $500 billion market had bloated to $1.3 trillion.
Wow.
And sitting here today, in early 2026, we are staring at a $1.8 trillion behemoth.
A $1.8 trillion balloon just waiting for a pin. And here's the reality check from the research. This is where the red flashing lights start going off. We are seeing terrifying bankruptcy statistics right now across the very companies that owe this $1.8 trillion.
It's grim.
Business bankruptcies have crossed 16,800. That is the highest pace we have seen since the immediate aftermath of the 2008 financial crisis. Businesses are fundamentally struggling under the weight of the high interest burdens they took on during that whole expansion phase.
They absolutely are. And what makes that $1.8 trillion figure so highly concerning is what is happening underneath the surface of those headline numbers.
In decay.
Right. When you look at the default rates officially reported by the massive fund managers who oversee these private credit portfolios, they actually look relatively tame. They project this aura of control. But fund managers often engage in what we call selective defaults, or they execute these friendly, consensual, out-of-court maneuvers.
Like debt-for-equity swaps.
Yes, specifically to keep the loans from officially looking like a total failure on the books.
Because if they officially declare a default, they have to write down the value of the asset, which hurts their fund's performance metrics and terrifies their investors. So they restructure it quietly. It feels a bit like painting over rust on a used car. Looks fine on the lot, but the structural integrity is compromised.
That is exactly the dynamic. But when you strip away that fresh coat of paint, when you look at the adjusted true default rate provided in the research, which actually accounts for those quiet restructurings, it is currently creeping toward 5%.
Which is a huge jump.
Just a couple of years ago, in 2021 and 2022, that number was sitting comfortably around 2%. So the real underlying distress in the system has more than doubled, even if the glossy quarterly reports mailed to investors don't explicitly show it.
And digging into the research, we find the exact mechanism that allows them to paint over that rust. It brings us to the PPIKE debt trap. PIK, payment in kind. The problem, really the absolute root of this entire issue, is that 40% of private credit borrowers right now have negative free cash flow.
It's an unbelievable metric.
40%. That is up from 25% just 4 years ago. That means 4 out of every 10 of the companies borrowing this money are bleeding cash from their daily operations. So the obvious question you have to ask is, how do they pay the interest on their massive private credit loans if they literally have zero cash?
They use payment in kind. To visualize how this operates in the real world, imagine you lend a significant amount of money to a friend so they can get a new business off the ground. You both agree that every month your friend is going to pay you a set amount of interest in cash.
Makes sense. Standard loan.
Right. But a few months go by, the economy shifts, and your friend's business isn't generating revenue. So when the monthly interest payment is due, instead of handing you cold, hard cash, your friend hands you a sticky note. And the sticky note simply says, I owe you this interest, just add it to the total amount of my loan, I'll pay you the interest on the interest later.
Wow.
That sticky note is essentially what PIK is.
And in the real world, if you are the one holding the sticky note, you know exactly how that usually plays out. Eventually, you have a mountain of paper promises, zero actual cash in your pocket to pay your own bills, and your friend is completely, hopelessly broke.
Precisely. It creates a horrific compounding feedback loop. The borrower defers the immediate pain of a cash payment by increasing their total long-term debt load. On paper, for the fund manager, this looks fantastic. They get to turn to their investors and say, look, the loan is still performing. Our internal rate of return, our IRR, is completely intact.
But it's an illusion.
Exactly, because in reality, they are starving the fund of actual liquid cash distributions. The research points out that public business development companies, or BDCs, which are essentially the investment vehicles that everyday retail investors use to access these private loans, are now getting 8% of their total investment income via these PIK sticky notes.
8%.
That is up from less than 4% historically. The interest coverage across the board is quietly failing.
It's all paper wealth.
Yeah.
And this has led to a massive realization sweeping through the institutional investing space right now. The new mantra, according to the data, is that DPI is the new IRR, meaning distributed to paid-in capital, which is the industry term for cold, hard cash that is actually returned to the investor's bank account, is suddenly vastly more important than the internal rate of return.
And we really need to pause on why that shift from IRR to DPI is such a structural earthquake in private equity and private credit.
Yeah, break that down for us.
For a decade, IRR has been heavily weaponized by fund managers. Because private markets are illiquid, managers have significant leeway in how they value the assets in their portfolio. They can use subjective internal valuations to artificially inflate their IRR. They can manage the timing of capital calls and distributions to make the percentage return look spectacular on a spreadsheet.
But you can't fake DPI.
Exactly. You cannot fake a cash deposit. An IRR that relies on a borrower who is fundamentally insolvent and paying in sticky notes does not buy groceries, and it certainly does not pay out the obligations of a massive state pension fund. Institutional investors are waking up to this. They are demanding actual cash returns.
And the private credit market is struggling to provide it because their underlying borrowers are suffocating. So we have to ask, what is pushing these underlying businesses over the edge? Why are 40% of them suddenly cash flow negative?
Right.
The research points to 2 massive, overarching macro catalysts driving this distress: artificial intelligence disruption and shifting global trade policies. We really need to spend some time here because this is what is actually breaking the $1.8 trillion market.
These are the exogenous shocks that are accelerating the bankruptcies at a terrifying rate. Let's look at the AI disruption first. Over the last 2 years, we have seen an explosion in applied AI, particularly in predictive logistics, supply chain management, and hyper-targeted consumer marketing. Companies that aggressively integrated these AI models have drastically reduced their overhead and optimized their inventory turnover.
Right, and the companies that didn't are suddenly dinosaurs. Let's ground this for you listening. Imagine a hypothetical mid-market company. Let's call them Acme Home Goods. They're a regional furniture distributor. Back in 2021, money was cheap. They took out a massive private credit loan to expand their warehouses.
But they didn't invest in AI predictive logistics.
Exactly. So today, in 2026, they are still ordering inventory based on outdated manual forecasting models. Meanwhile, their AI-enabled competitors know exactly what the consumer wants before the consumer even knows it. Acme ends up with warehouses full of the wrong furniture, which they have to heavily discount to sell. Their profit margins absolutely collapse.
And that margin collapse from technological obsolescence is devastating on its own. But then you compound it with the second macro shock, the shifting trade environment. The research explicitly highlights the Liberation Day tariff announcements that were implemented back in April of 2025.
And we want to be perfectly clear here. We are just impartially reporting the data from the research. We aren't taking any political stance on the tariffs themselves, whether they were a good policy, a bad policy, or indifferent.
Of course.
But objectively, as a financial catalyst, those April 2025 tariffs created a massive immediate shock to industrial and retail supply chains.
As a macroeconomic event, the disruption was profound. Going back to your hypothetical Acme home goods, not only are they struggling to sell their inventory because they lack AI integration, but suddenly the cost of importing the raw materials and parts they need to build that furniture spikes by 20% overnight due to the new tariffs.
And they can't pass that on.
Exactly. They cannot pass those massive price increases onto a consumer base that is already feeling inflationary pressure.
So they eat the cost. Their margins go from compressed to non-existent. Acme Home Goods goes from being a highly profitable enterprise in 2021 to burning cash every single month in 2026. They become part of that 40% statistic. And because they are burning cash, they have to call their private credit lender and ask to pay their monthly interest in PIK sticky notes.
That is the exact anatomy of the current crisis. You have these severe supply chain shocks compounding with AI logistics failures. It is creating highly distressed, raggedly deteriorating situations for thousands of middle market companies. And here is the fatal structural flaw in the private debt market. Traditional clubby lending structures are entirely inflexible.
Right.
They were designed for a stable macroeconomic environment. When a business like Acme needs to pivot its entire operational model to survive a technological and regulatory shift, a rigid private credit loan weighing them down with compounding PIK interest is an anchor dragging them under, not a life preserver keeping them afloat.
So the underlying loans are rotting. The businesses are struggling. The obvious question any rational listener is going to ask is, if the system is breaking, why don't the investors just take their money out? Why not just sell their position in the private credit fund and move to cash or safer assets?
That is the logical next step.
Right. Well, that brings us to the liquidity illusion. I like to call this the Hotel California of finance. We are talking about these massive evergreen or semi-liquid private credit funds that have been aggressively marketed to both retail and institutional investors over the last 5 years. They market themselves as offering you peace of mind. But the reality is like a Roach Motel or the Hotel California. You can check your money in any time you like, but you can never leave.
It is the redemption trap, and it is perhaps the most frightening aspect of this entire market structure for an investor. When corporate credit quality deteriorates as rapidly as we just discussed, the natural, rational reaction for an investor is to rebalance their portfolio.
Yeah, get out of harm's way.
They see the bankruptcies rising, they see the macro shocks, and they want to pull their capital out and move it to a safe haven. But the liquidity that was implicitly promised by these massive funds is, as the research clearly demonstrates, entirely illusory.
Let's dive into the first case study from the research to show exactly how this plays out. We are looking at BlackRock's HLEN fund, HLEND.
Yes, the HPS Corporate Lending Fund. This is not a fringe player. This is a $26 billion behemoth managed by one of the most powerful financial institutions on Earth. It is one of the most prominent non-traded BDCs available. In March of 2026, retail anxiety spiked.
Naturally.
Shareholders looked at the macro environment, they saw the 16,800 bankruptcies we talked about, and they hit the sell button. They requested redemptions for 9.3% of the fund's outstanding shares.
Which objectively doesn't sound completely insane. Almost 10% of people wanting their money back during a stressful economic time seems like a normal market function.
You would think so.
But here is the trapdoor that caught everyone off guard. BlackRock legally capped repurchases at just 5% of the fund's value. I want you to imagine the sheer visceral panic you would feel in that situation. You log into your brokerage account, you ask for your life savings back because you are terrified about the direction of the economy, and the institution looks at you and says, sorry, you can only have half of your money right now. The rest is locked up indefinitely.
And it is vital to point out that what BlackRock did was entirely legal and totally consistent with the fund's prospectus. It was in the fine print.
Right, but who reads the fine print on a $26 billion fund expecting to be locked out?
Well, that's exactly the problem. The mismatch between the retail investor's expectation of standard market liquidity and the deeply inherently illiquid nature of the private loans the fund actually holds. BlackRock cannot just hop onto an exchange and sell a highly customized distressed corporate loan to Acme Home Goods in a Tuesday afternoon trading session to generate the cash to pay back the retail investor.
It just can't do it.
They can't. The realization that principal is locked away behind a gate during a period of market stress completely shatters the peace of mind narrative that these semi-liquid vehicles use to attract capital in the first place.
And the contagion wasn't isolated to just BlackRock. Case study 2 from the research focuses on Blackstone's BCRED fund, BCRED. And the numbers here are even more staggering. We are talking about an $82 billion flagship private credit fund, the crown jewel of their credit operation.
The escalation at Blackstone was severe, and the internal response was highly telling. In early 2026, redemption requests hit 7.9% of the fund's total value. Now, their standard legally defined quarterly limit for withdrawals was 5%.
So they hit the wall.
They smashed into it. Because the requests so vastly exceeded the limit, they were looking at a total freeze of investor capital, an absolute public relations nightmare, and the potential for a catastrophic run on the fund that could spill over into their other vehicles.
So what did they do to stop the bleeding? This detail in the research is just striking to me. Blackstone had to raise the redemption cap to 7%. And to actually generate the liquidity to honor those withdrawals, they engineered a highly unusual $400 million capital injection coming directly from their own senior leaders and internal employees.
Incredible.
They literally had to pass the hat internally among their own executives just to satisfy retail withdrawal requests and prevent a total systemic meltdown of confidence. And even with all those unprecedented heroics, the net outflow was still $1.7 billion for the quarter.
When the executives of a fund have to personally inject nearly $500 million to provide exit liquidity for retail investors, it is a massive, blaring signal of shifting investor sentiment. It demonstrates unequivocally that when corporate bankruptcies loom large on the horizon, these redemption limits, these gates, suddenly transform from a boring footnote in a prospectus into the primary risk factor for the entire asset class.
And it feeds perfectly into what the research calls valuation paranoia. If I know the gates are going to slam shut the moment things get tough, it fundamentally changes my psychology as an investor. Because these funds use totally opaque internal valuations. They essentially grade their own homework when it comes to pricing the loans in their portfolio.
Yes, the mark-to-model approach.
Exactly. Investors are terrified. They are deeply scared that they are pulling their money out based on fake inflated prices of distressed loans. If the fund manager insists that a loan is worth 100 cents on the dollar, but the investor suspects it's really just a struggling borrower paying their interest with PIK sticky notes, the investor wants to get out immediately before the fund is inevitably forced to admit the loan is only worth 60 cents.
Precisely. The opacity of the private credit market breeds panic. In a public market, you have price discovery. You know exactly what an asset is worth at any given second. In private credit, if you cannot see the true market value of the underlying assets, and you know the exit door is incredibly narrow and tightly controlled by the manager, the only rational move is to rush for the door as early as possible.
First one out wins.
The first one out gets par value. The last one out gets a locked account and a portfolio of sticky notes.
It is a stampede in the dark. Everyone is running for an exit they can't clearly see. Speaking of looking for transparency and better models, real quick before we jump into the deep end, if you are getting value out of this show, we request you to check us out on fountain.fm. It's a value-for-value player where you actually get paid for listening without advertisements blocking your experience. It's a great platform.
It really is.
And of course, you can listen to us on Spotify, Apple Podcasts, or YouTube Music for free, or wherever you get your audio fix. As for videos, we still need to hit our goal of 1,000 subs on YouTube to start using the Mosaic AI video editor. Mosaic is truly a game changer for small creatives like us. It really is. We can feed it a YouTube link and it creates beautiful AI, cinematic captions, infographics, and a whole lot more we're still discovering in our capability test. We can't be more thankful that you all are as fascinated by these deep dives as we are. The key to this vote of confidence is the research we share on our website.
Exactly. No login needed, no cookies, no trackers, and absolutely no advertisements. So please, if you want to dig deeper into the numbers, check the link in the descriptions because today is a big one. Huge.
Coming out of the murky, gated Roach Motel world of traditional private credit, we are pivoting entirely to what the research categorizes as absolute openness. If private credit is a locked door in a dark room, this next entity is a glass house at high noon. Enter Strategy Inc.
This is where the paradigm of global finance entirely shifts. Strategy Inc. operates from a position of profound, almost unprecedented structural strength. To understand the leverage they wield in the market today, you just have to look at their balance sheet as of March 2026.
It's massive.
They have positioned themselves as the world's largest Bitcoin treasury company. They are currently holding roughly 720,737 Bitcoins on their balance sheet.
I really need to repeat that number so it sinks in for you listening. 720,737 Bitcoins. The aggregate cost to acquire that digital treasury was $54.77 billion. They aren't just a participant in the market, they are a behemoth.
And leveraging the sheer weight of that massive digital treasury, they engineered a completely new financial instrument. Traditionally, companies like this would just issue more common stock to raise capital, but they pivoted. They designed a highly sophisticated preferred capital structure that was tailored specifically, almost surgically, to attract the fixed income investors who are currently fleeing the chaos and opacity of the private credit markets we just discussed.
And this instrument is the focal point of the research today. It is called STRC. The full technical name is the Variable Rate Series, a perpetual stretch preferred stock.
It's a mouthful.
It is, but the scale of this issuance is what really commands attention. It IPO'd in July of 2025, and the market response was overwhelming. Less than a year old, and the research shows that in 2025 alone, STRC accounted for 33% of the entire U.S. preferred market issuance. One single security captured a third of the market, raising $7 billion.
It was an immediate, resounding validation of the concept by institutional capital. But to understand why it captured 33% of the market, we have to look at the mechanics, because that is where the stark contrast to the gated world of private credit really shines. STRC trades publicly on the NASDAQ. That means it offers daily liquidity. If you are an investor and you decide you want your capital back on a Tuesday at 11:00 a.m., you click sell in your brokerage account and the trade executes at market price. There are no 5% quarterly redemption gates. There is no waiting for executives to pass the hat to find your money. It has a stated $100 par value, and it offers transparent, real-time market pricing every second of the trading day.
And this brings us to what might be the most fascinating feature of the entire security: the 11.5% yield thermostat. Currently, as of March 2026, the annual dividend rate on STRC is sitting at 11.5%, payable monthly in actual cash. And the research notes they have actively raised this rate for 7 consecutive months.
Yes.
But when most people hear crypto-linked asset, they immediately think of massive stomach-churning volatility. How exactly does Strategy Inc. neutralize that volatility to attract conservative fixed income investors?
It is a brilliant piece of financial engineering. The best way to conceptualize this is to think of the board of directors at Strategy Inc., acting exactly like a person standing in a hallway adjusting a thermostat. Their primary goal is to keep the room temperature, which represents the trading price of the STRC stock, at a very comfortable 100 degrees, or in this case, right at its $100 par value.
Okay, I'm tracking with the analogy. So what happens when the market conditions change?
Let's say the broader market gets nervous. Maybe there's a macroeconomic shock, and investors start selling off equities, including STRC. The price of STRC might drop from $100 down to, say, $95. In our analogy, the room is getting too cold. So the board of directors walks over to the thermostat and turns up the heat. They announce they are raising the dividend yield from, say, 11.25% to 11.50%.
Oh, I see.
Suddenly, yield-hungry investors in the market look at that new, higher yield, realize it is an incredible relative value compared to other assets, and they rush in to buy the STRC stock. That massive influx of buying pressure naturally brings the share price right back up to that comfortable $100 par value.
And I imagine it works in reverse as well. If the market is euphoric and the price of STRC gets too hot, say it trades up to 105, they can dial the yield back a bit to cool it down, saving the company money while maintaining that $100 equilibrium.
Exactly.
By adjusting this yield dynamically every month, they effectively strip away the notorious volatility of the underlying crypto assets. It creates what the research categorizes as a highly responsive digital yield curve. It is real-time adaptation to market forces. Compare that to traditional business development companies, which are stuck paying fixed rates or waiting for rigid quarterly distribution schedules while their underlying loans silently decay.
The flexibility is their ultimate weapon. So as an investor, you are getting an 11.5% yield, which absolutely crushes the 8% to 8.5% you might hopefully squeeze out of a senior secured private credit loan right now. And you are getting it with daily public market liquidity.
But I have to push back here. Yield and liquidity mean absolutely nothing if the principal isn't safe. If the underlying asset collapses, the yield is just a consolation prize on the way down.
That's entirely true.
Which leads us to the core argument of the research, the three pillars of STRC supremacy. Pillar number one is what the research calls the mathematical moat, or principal protection. Now, I have to be completely honest. If someone on the street tells me that a crypto-linked asset is structurally safer than a traditional corporate loan backed by a real operating company with physical assets, my first instinct is deep skepticism. How can that mathematically be true?
It is a highly counterintuitive claim, but it all comes down to asset coverage and the structure of the capital stack. Let's use a real estate analogy to make the math intuitive. Imagine you own a massive, incredibly beautiful mansion. The current real estate market values your mansion at $50 million, but you only owe $8 million on the mortgage to the bank.
Okay, so I have a massive equity cushion. I own mostly the house, not the bank.
An immense amount of equity. Now, let's introduce a catastrophic scenario. Let's say the local housing market experiences an apocalyptic crash. Property values across the board plummet by 80%. Your beautiful mansion goes from being worth $50 million down to just $10 million.
That is a brutal hit for me as the homeowner.
It absolutely hurts you, the equity owner. But we have to look at it from the perspective of the bank. The bank is owed $8 million, and even after an 80% crash, the house is still worth $10 million. If you completely default on your payments, the bank forecloses, sells the house at the deeply depressed price of $10 million, takes their $8 million to cover the loan, and they are totally fine.
Right, because of the buffer.
The bank's principal is entirely protected even in an 80% market crash simply because of the massive initial over-collateralization.
Wow. Okay, so how does that real estate logic translate to the capital stack of Strategy Inc. and the safety of STRC?
Strategy Inc. is essentially that $50 million mansion. If we look at their capital stack, which is just the hierarchy of who gets paid first, they have approximately $8.25 billion in senior debt and $8.47 billion in preferred stock notional value, which includes STRC.
So roughly $16.7 billion in total obligations that need to be paid out.
Yes. Against that $16.7 billion, they hold their massive treasury of 720,737 Bitcoin.
And here is the solvency calculation from the research that really puts it into perspective. For the company to even theoretically struggle to pay back the principal value of the preferred stock, for them to actually default on STRC, Bitcoin would have to crash to an astonishing $8,000 per coin.
Yes, that is the $8,000 floor. If Bitcoin dropped all the way to $8,000, their 720,737 coins would still be worth about $5.76 billion. But you also have to factor in their cash reserve, which is currently sitting between $2.25 billion and $2.5 billion in US dollars. Combine the depressed Bitcoin value with the cash, and you have roughly $8 billion to $8.25 billion in highly liquid assets. That perfectly covers the senior debt.
But wait, I have to challenge this premise. Markets are rarely strictly rational. Let's say Bitcoin drops 70% to $30,000. The math says STRC is still wildly over-collateralized, but wouldn't a 70% drop in Bitcoin trigger a massive psychological panic sell-off of STRC anyway? Right. Wouldn't the price plummet regardless of the $8,000 floor?
It is an excellent point, and it highlights the difference between price volatility and structural solvency. Yes, in a massive crypto drawdown, the market price of STRC might temporarily experience volatility as retail investors panic sell. The share price might drop from $100 down to $85. However, the company is not obligated to redeem your shares at market price. They are solvent. They can continue to pay the 11.5% dividend entirely uninterrupted. Furthermore, the board would simply use the thermostat mechanism we discussed, raising the yield to 13% or 14% to attract institutional arbitrageurs who recognize that the math still works.
And they would aggressively buy the dip.
Exactly, which would force the price back to par. The mathematical moat protects the capacity to pay, which ultimately dictates the long-term value of the preferred equity.
So Bitcoin would have to experience a catastrophic 90% plus drop from its late 2024 peaks and stay there before the principle of STRC is even marginally threatened. When you compare that level of over-collateralization to traditional private credit, the contrast is stark.
It's night and day.
Over in the private credit world, your principal is tied to Acme Home Goods, a mid-market retailer struggling with tariffs and failing to adapt to AI logistics, who is currently 40% cash flow negative and paying their interest in sticky notes.
Exactly. When you analyze the structural integrity side by side, it becomes abundantly clear why the research categorizes STRC's asset coverage as sovereign grade. It is a mathematical moat that traditional cash flow dependent corporate debt simply cannot replicate.
Which brings us directly to Pillar 2, the cash fortress or dividend security. Because, look, a company might have a mathematical moat, they might survive a crash, but if cash gets tight, they might just decide to stop paying the dividend to conserve resources. We see it all the time. It's called a distribution holiday. What is structurally stopping Strategy Inc. from just turning off the 11.5% spigot if we enter a prolonged crypto winter?
This is where the foresight of their treasury management truly shines, and it separates them from traditional operators. Strategy Inc.'s 2026 annual report revealed a massive, highly specific US dollar cash pile. We are talking about $2.25 billion, rapidly growing toward $2.5 billion, that is firewalled and earmarked specifically for one primary purpose: paying dividends and interest obligations.
So they aren't relying on selling Bitcoin to pay the yield. They literally set aside billions of actual fiat dollars in a bank account just to make sure the monthly payments never stop, regardless of what the crypto market is doing.
Precisely. They have preemptively entirely mitigated the distribution risk. They do not have to sell a single Bitcoin at any price to service the yield on STRC. Even if we enter a brutal multi-year crypto winter where the price of Bitcoin is severely depressed, they can simply draw down on this cash fortress to honor that 11.5% monthly payment for years without missing a single beat.
The contrast here is just striking. Traditional private credit funds rely on the month-to-month cash flow of their underlying corporate borrowers to fund their investor payouts. And we have already firmly established that 40% of those borrowers are currently cash flow negative.
It's a house of cards.
The private credit fund is sweating every month, hoping Acme Home Goods sells enough furniture to make the payment. Meanwhile, Strategy Inc. relies on a $2.5 billion mountain of cash already sitting safely in a bank account.
It is the fundamental difference between hoping for a yield based on operational performance and structurally guaranteeing the capacity to pay it based on pre-funded reserves.
Okay, let's move to Pillar 3, because this is where the financial engineering really flexes. Pillar 3 is the tax magic, return of capital. An 11.5% yield sounds phenomenal, but the tax man always cometh. If I am getting an 11.5% yield from a traditional corporate bond or a private credit fund, I'm usually losing almost half of it to taxes immediately if I am a high net worth investor. How does STRC legally bypass that enormous tax drag?
It all comes down to a very specific structural tax treatment under the Internal Revenue Code, specifically Section 301C. Because of how Strategy Inc. manages its earnings and profits relative to its distributions, it expects its preferred dividends to be treated not as ordinary income, but as a return of capital, or ROC.
Okay.
Now, the mechanics of Section 301C can get highly dense, so let's visualize this with an analogy.
Please do.
Imagine you go to a premium dealership and buy a brand new car for $50,000, but the dealership is running a very aggressive long-term promotion. Every single month, they mail you a $500 cash rebate check. Now, when tax season comes around, does the IRS demand that you pay ordinary income tax on those $500 rebate checks?
No, of course not, because it's a rebate.
It is
It is essentially just my own money being returned to me over time, which effectively lowers the true out-of-pocket price I paid for the car.
Exactly. The IRS views a return of capital dividend through the exact same lens. That 11.5% yield is treated as a rebate. It steadily lowers your official purchase price, what we call your tax basis, in the STRC stock. Because it is viewed as a return of your original principal, you do not pay any immediate ordinary income tax on it when it hits your account.
That is massive.
It is. You only trigger a taxable event if you eventually sell the STRC stock for more than your new, lowered tax basis. And even then, if you have held the stock for more than a year, it is taxed at the much lower preferential long-term capital gains rate, not the punishing ordinary income rate.
And taking that a step further into estate planning. If you hold that STRC stock until you pass away, through the step-up in basis rules upon inheritance, Your heirs might potentially avoid those deferred taxes entirely. That is incredibly powerful, legally sound tax optimization. So what does this return of capital treatment mean for the actual bottom line numbers an investor cares about?
To measure this, we use a metric called the taxable equivalent yield, or TEY. This allows us to compare tax-advantaged yields with fully taxable yields on an apples-to-apples basis. Let's look at a high net worth investor, someone sitting in a combined federal tax bracket of around 40.8%, which is a 37% top marginal rate plus the 3.8% net investment income tax.
Okay, that's a heavy tax burden.
It is. If that investor buys a traditional private credit fund yielding, let's say, a very respectable 9.7%, they are forced to pay massive ordinary income tax on that yield immediately every single year.
So that 9.7% gets aggressively chopped down. After taxes, they're really only putting maybe 5.7% in their pocket.
Exactly. But with STRC, that 11.5% yield is a return of capital. It completely bypasses that immediate 40.8% tax drag. When you mathematically account for avoiding federal taxes, dodging state taxes in high-tax jurisdictions, and the compounding power of tax deferral, that 11.5% STRC yield is effectively the equivalent of a fully taxable traditional bond paying a massive 20%.
So let me summarize this choice for the listener because it is stark. As an investor, I can choose option A. I can lock my money inside an opaque, gated private credit fund where I can't get it out when I want to. My yield relies on distressed borrowers like Acme Home Goods who are bleeding cash and paying the fund with sticky notes. And for taking all that risk, I get a highly taxed 9.7% yield.
Right.
Or I can choose option B. I can buy STRC on the public NASDAQ exchange, getting full daily liquidity. I can backstop my principal with a massive, transparent $54 billion mathematical moat of Bitcoin, and I get an effective taxable equivalent yield of 20%.
When you meticulously lay the two options side by side, exactly as the research outlines, the structural and after-tax superiority of STRC is mathematically undeniable. It is a highly compelling proposition for sophisticated, institutional, and high-net-worth capital that is actively seeking safety and yield.
And that leads us perfectly into Section 5,
Yeah.
market volume and the open credit migration. Because if a financial instrument is truly as revolutionary as the math suggests, we shouldn't just see it in the models. We should see it in the market behavior. Everyone should be migrating toward it. And the proof is unequivocally in the trading volume. Barely 6 months old, STRC is seeing an average daily trading volume, an ADV, of over 1.7 million shares. That is an absurd level of liquidity for a brand new preferred stock issuance.
It is exceptionally rare. To see a new issuance achieve that level of velocity means it is rapidly closing in on the liquidity levels of massive, decade-old established preferred ETFs. And what is truly telling, perhaps the most significant data point in the research, is the institutional acceptance.
They are buying in.
The traditional, conservative, suit-and-tie professional investment community has completely surrendered to the math. If you look at major foundational institutional ETFs, like the iShares Preferred and Income Securities ETF, trading under the ticker PFF, STRC is already a top 5 holding with a 1.48% weighting.
The largest asset managers in the world are buying it in bulk. They are actively fleeing the opaque, clubby private credit world to gain exposure to this absolute openness. And this migration of capital creates what the research calls a reflexive growth loop, or a flywheel effect. This is a fascinating mechanism. Walk us through how this flywheel actually accelerates Strategy Inc.'s dominance.
It is a self-reinforcing, virtuous cycle that traditional finance cannot easily replicate. Let's break down the steps. Step 1, investors highly attracted by that 20% taxable equivalent yield, the daily liquidity, and the structural safety aggressively buy STRC in the open market.
Makes perfect sense.
Step 2, Strategy Inc. takes the billions in cash proceeds from those STRC sales and immediately uses that capital to buy more Bitcoin on the open market.
Okay, so their underlying digital treasury gets even larger.
Exactly, which leads to step 3. Because they now hold even more Bitcoin against the same relative obligations, the asset coverage ratio increases. That mathematical moat we talked about gets even thicker. The theoretical $8,000 floor drops even lower.
The foundation just gets stronger.
Yes. Step 4. Because the mathematical coverage is demonstrably stronger, the perceived risk of the STRC security goes down in the eyes of ratings agencies and institutional risk models. And finally, step 5. Because the quantified risk is now lower, even more conservative institutional buyers are given the green light to buy STRC, and the entire cycle repeats itself with greater velocity.
That is an incredibly potent growth engine. Investors buy STRC, Strategy Inc., buys more Bitcoin, the collateral coverage increases, the risk drops, and more people buy STRC. And traditional private credit, completely bogged down by 16,800 bankruptcies, struggling to collect sticky note PIK interest from Acme Home Goods, simply cannot replicate this model.
They can't even come close.
They do not have an appreciating, globally liquid digital asset on their balance sheet to continuously backstop and expand their lending capacity.
They are structurally trapped. Traditional private credit is increasingly looking like a relic built for a low-interest rate era that no longer exists, while Strategy Inc. has engineered a modern, digitally backed yield machine designed to thrive in the current macroeconomic reality.
We have covered a truly massive amount of ground today, unpacking the mechanics of a $1.8 trillion pivot. To summarize for you listening, we are witnessing a monumental migration of capital. The smartest money in the room is actively fleeing the opaque, gated Roach Motel world of traditional private finance.
Who's running for the exits?
Exactly. They are running away from selective defaults, subjective valuations, and negative cash flows. And they are rushing toward the absolute openness, the undeniable daily liquidity, and the mathematically transparent blockchain-verified assets backing STRC. Looking at the data we've analyzed today, it truly feels like STRC is positioning itself as the final arbiter of value in this new financial cycle.
The convergence of widespread corporate distress in the traditional markets and highly innovative financial engineering in the digital asset space has created a perfect storm. It is a textbook example of capital flowing to where it is treated best, protected most securely, and compensated most fairly.
But before we let you go, I want to leave you with a final provocative thought. Something for you to chew on that builds on all the research we've discussed today, but explores the logical extreme of this trend. Think deeply about this. If Strategy Inc. can successfully bypass the traditional banking syndicates and private equity gatekeepers entirely, if they can use a digital asset like Bitcoin on their balance sheet to mathematically backstop a traditional preferred equity stock, offering a 20% effective yield while maintaining a fortress balance sheet, what is stopping every other major Fortune 500 company from adopting this exact same playbook?
It raises an incredibly profound question about the ultimate future of global capital markets. If an entity the size of Apple or Microsoft or Amazon decides to aggressively build a digital treasury on their balance sheet and begin issuing their own open credit instruments.
Exactly. Could this open credit model, backed by immutable digital reserves, eventually render the entire $1.8 trillion private equity and private credit industry completely obsolete? Why on earth would a major corporation borrow from a traditional private equity firm with restrictive covenants when they could just issue their own highly attractive liquid preferred stock backed by their own digital treasury? It is a massive structural question to think about as you watch this market continue to unfold in the coming months. Thank you so much for joining us on this deep dive. Keep questioning the consensus, keep looking closely at the underlying math, and we will see you next time. I'm Satoshi.
And I'm Satoshi.